Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
Oh, good day. How you going? Phil Tarrant here. I'm the host of the Smart Property Investment Show, and this is our monthly installment, Property Finance Uncut, recording the day that the Reserve Bank of Australia gets together and work out what they're going to do with interest rates. The good news is that they haven't done anything with it this month, and I think maybe never again, at least on this cycle. Who knows? One bloke that probably does is Paul Glossop, CEO of Finni Mortgages, finni.com.au. Paul, what are you seeing? What are you reading? Are you happy? Rates aren't going up. I know you've got some mortgage, so that's a good thing, right?
It's very, very true, mate. My mortgages are variable, so they're very much going to be impacted by any decisions. And I think the reprieve for December is most welcome by anyone who obviously is holding some debt going into the Christmas period. And obviously that means that it's going to be February is the next time that we're going to see any discussion. So essentially we've got 2 months of pause time now. Hopefully 2 months of a lot more data to come through. And I think to your point a second ago, buddy, is that I think we're at the point now where we may be very much at the top of this cycle.
Yeah, I think we're there. And my readings and understanding of global economic forces, particularly the westernized countries, and to that I think of Canada, the US, and the UK, indications are that the Federal Reserve, the central bank in the US, will start cutting rates. What they always say is that Australia normally lags those other markets by a little bit. So it's taken us a lot longer to get to our terminal rate. And look, is there one more rate rise? Potentially, perhaps. It's going to depend on a number of different factors. But let's just assume we're at or near the top. Indications is that the Fed will start cutting next year. And typically, we're sometime behind the Fed, but already economists in Australia are talking about or reaffirming potential for rate cuts in the end of next year. Is that correct?
That's correct, mate. And I think to your point, if you look at this whole cycle and the timing in which everything's played out, not just in Australia versus the US, but US typically is leading, whether it's cuts, whether it's increases, and any of those other lead indicators. And if we look at where we're a good 4, 5, 6 months behind on the start of this cycle. And I think we may be a little bit early. We may be in line with that again. But the reality is that the economists over in the US pointing towards the Fed looking potentially towards 0.75% worth of interest rate cuts in 2024. And that's going to further cut by potentially another 0.5 to 0.75 for 2025. So they're forecasting potentially their rate to be down circa 1.25 to 1.75% versus where it is now in the next 2 years. And the likelihood is that now we're going to be following that trend in probably the next 6 to 12 months.
Yeah, Australia is very different to the American mortgage market in that in America, for what I understand, people take on really long-term fixed rate mortgages. So maybe their narratives in their discussions probably aren't as pointy as what they are here. A lot of Australians are on variable rate products. That said, though, any reductions to the official cash rate should hopefully play out in reductions from the major or the banks to cut them. They typically are very quick to pass on interest rates on the way up, and then they'll cite all the reasons why they need to keep interest rates high on the way down, and that's just the nature of the beast. But irrespective, Paul, there's not a podcast around the economy or economic forces or interest rates particular. It's about what do you do about it and how do you secure the best mortgage finance, whether it's your owner-occupier mortgage or if you're a property investor. What should investors be doing right now, considering the pause today?
What we're seeing the majority of really sage, both property owners for their principal place of residence and investors really start to consider now is that because we're likely very close to, if not already at the top of this cycle, if they have the ability to refinance to a sharper rate and at the same time extract equity as part of that same process. As we know, Phil, if you look through data over the last 30 years, when you start to see you're at the top of an interest rate cycle and it's on the way down, ultimately cheaper money, in addition to where we are from a population growth perspective, is likely going to lead to assets increasing in value in certain areas. Now, what a lot of people are thinking is that if I am in a position to A, refinance, B, extract equity and get ready to buy, it's probably a time in the cycle where they're considering buying that asset from a long-term investment standpoint, because the long-term and also the short-term growth starts to now point towards a much quicker and rapid uptake of growth as money gets cheaper. So The sage investors, well, they're out there right now thinking, okay, I'm going to position myself, I'm going to reprice my property. Obviously, we've now seen CoreLogic data come out for November to suggest that essentially nationally, we're now pretty much at the equal heights of our previous peaks of asset prices nationally that we've ever seen. And that goes back to the start of 2022 when it peaked then, obviously saw a reduction in value and now is retraced in that pretty much a V-shaped recovery. So assets are at their highest value, which means equity is at its highest position. So if they have the ability to refinance, they're doing so.
Yeah, absolutely. You've got to be thinking about that as a property investor, but you also got to be thinking about the cost to hold your mortgages or mortgage. It's ensuring you got the sharpest rate possible, but also looking at rents, which is on the income side of things. I know rents continue to rise right across Australia. You look at some markets, Perth and Brisbane, for example, there's still very strong rental markets, and it's playing out also in Sydney, maybe Melbourne less so. But if you haven't reviewed your rents for a little while to help sort of cover the costs of your mortgage, increased mortgage repayments over this period of the upwards rate cycle, it's well time to look at it.
Absolutely, mate, because I think they're going to be the two big dynamics that are going to play out for 2024 and 2025. We're going to see the cost of money likely to reduce, the cost of actually renting a property to increase. So we're going to see those forces to push renters to probably consider buying that first home. And we're potentially also going to see that investors who are holding assets, their cash flow position on their properties is likely to be probably the tightest it will be right now versus what it's likely to be over the next 3, 4, 5 years, because the cost of holding that mortgage versus the income that's generated from that investment is likely to be getting better. That market and the market forces are likely to improve quite dramatically over the next few years. So that's certainly, I think, a theme for 2024 and 2025.
Yeah, and if you are a first-time buyer thinking about buying during that period of time, you might be renting right now, but looking to or thinking about investing in property, tuning into this particular podcast, get it sorted out now. Start cutting your costs to operate yourself now. That means the balance sheet, your personal balance sheet. Start removing those expenditures, start saving money, putting aside, looking at what incentives are available for you from state and federal governments, getting a really nice, clean balance sheet. So when you rock up to your mortgage broker, a Finni broker, and say, hey, I'm ready to buy my first home, here's my deposit, and I'm a pretty healthy, responsible person, it's going to be a lot easier to secure mortgage finance, right?
Absolutely, mate. And I think that's the big thing, is that going and refinancing, sometimes for those who run a tight ship from a home finances perspective, is sometimes quite simple, but it's essentially like anything. If you want to put your best foot forward, you've got to make sure your house is in order, so to speak, in the sense that make sure your finances are there, your expenditure over typically a 2 or 3 month period as a minimum looks as airtight as possible. Cut away those unnecessary costs, increase your actual revenue, your income where possible, and minimize those unnecessary expenses to put your best foot forward when you're actually saying, here are my numbers to the bank, and this is what I want to borrow. They want to see, or you should get them to want to see your numbers in their absolute best light possible. So start that work today if you haven't already done so. And if you have already done so, then getting in touch with the team at finni.com.au to then go through what are those options and where can we then position your loan, your potential refinance, and that potential new purchase. All these things can be considered at the same time.
So your team's happy just to get people mortgage ready, even though it might be a year away, a year and a half away. That's cool.
Yeah, absolutely. And I think, look, year away, year and a half away, there's some good advice we would give. We probably wouldn't go through all the rigmarole of requesting documentation, etc. We'd probably get more the top line information. But it's also quite important to give those points and tips on, here's what you probably need to consider doing. Here's things that you can cut out, whether they're subscriptions, whether they're expenditures, whether they're going to be unnecessary gym memberships, whatever they look like. There's some advice that can be given to then say, okay, if you're looking to buy in 6 months, 12 months, 18 months, start these steps now. And then all of a sudden you're in a position when you do go to them to go through that full pre-approval or full approval process, you've actually already got all of your ducks in a row.
All right, nice one. We'll go and check out Finni if you need help with your mortgages. That's F for Fred, INNI.com.au, Finni Mortgages. Paul's the CEO there, but you get a hold of one of his very capable brokers. No doubt they can help you out. And there's still time before Christmas, Paul.
This is the time to get your ducks in a row. So I think we're spending the next 2.5 weeks in catching up with clients who are preparing themselves, not necessarily to purchase before the end of 2023, but saying, okay, 2024 is going to be my time. We're there to say, let's prepare you, let's get your money ready to go so you can actually hit the ground running for 2024.
Excellent. Nice one. Well, thanks for your time today, Paul. It's Paul Glossop, CEO of Finni Mortgages. Thanks for tuning in, everyone. Lots of commentary on smart property investment around mortgage financing. Go and check it out. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.